Good evening, ladies and gentlemen. Today are four eminent market economists, and let me introduce them. Pranjul Bhandari, who is the HSBC's India chief economist. She, before joining HSBC, was a resident, held a resident fellowship at the IMF in Washington, D.C., and graduating from the Kennedy School as a Mason Fellow. Previously, she's worked at the Ministry of Finance with the Chief Economic Advisor, and prior to that, at the Planning Commission with the Deputy Chairman. She's held roles as an economist covering Asian markets at Goldman Sachs and at UK's Department of International Development, DFID. We also have Samiran Chakraborty, Managing Director and Chief Economist of the Citigroup. Prior to joining Citigroup, he was the head of South Asia macro research at Standard & Chartered, and prior to that, chief economist for ICICI Bank. He's moved into being a market analyst after having been a professor at the Delhi School of Economics, teaching for a number of years, as well as being a visiting faculty at the Jawaharlal Nehru University. Next up, we have Devendra Pant, chief economist and senior director at India Ratings and Research Private Limited. I'm pleased to say that DK was a fellow colleague at the National Council of Applied Economic Research through the late 1980s to the early 2000s, where he worked on a number of topics, including growth, policy, and human development. He's worked as an in-country expert for Oxford Analytica, a member of the United Nations Expert Group on Economic Valuation of Hydrological Services, and a visiting scholar at the University of Pennsylvania. Last is Nikken Mishra, Managing Director and India Equity Strategist for Credit Suisse, rated amongst the best analysts in India by Institutional Investor and Asia Money. He's been an advisor to various government committees, including the Revenue Neutral Rate Committee of the GST and the Fiscal Responsibility and Budget Management Review Committee. And he, of course, writes frequently, as do all four of them. Prior to that, he has worked on a number of different industries in Mumbai, Singapore, and Taipei. And in his first avatar, he was senior technical architect with Infosys and also has worked with Hindustan Levers. So, ladies and gentlemen, this is an expert group that we hope to hear from, and we want to listen to on how they think we should both protect and rebuild the economy. Let's start first with Nikken Mishra. Neelkanth?
Yeah, so you see, I think we are at a very crucial stage of assessing the future for our economy. We need to look at it in two silos. The first is the phase during the lockdown, and the second is the phase after the lockdown. A different set of analytics and government prescriptions for government action and RBI action will be necessary during the lockdown, and of course, then different from what happens after the lockdown. One of the key concerns that I think has emerged in the last week, 10 days, is that the end of the lockdown, which anyway was looking as if it would not be as abrupt or as discreet as it was, say, in Wuhan, where after 76 days of a very, very harsh lockdown, they had a big celebration and the city sort of came out. It was anyway appearing that we would have a much more staggered pace of relaxation. Now it is appearing that we will perhaps not be able to control the virus at all, and that we may have to live with it for several quarters, if not more than a year. And which means that this phase of the lockdown would actually be a much more prolonged one than perhaps we would have anticipated a month back. What happens during the lockdown? I think the attempt of the policymakers should be to minimize the damage. There is damage potentially on four fronts. The first is the financial system. We've already seen one victim, at least the bond market, I think, is now seeing steady outflows. the first attempt by the RBI doesn't seem to be working, and we need some urgent action to address that. The financial system capacity, I think, has been quite badly damaged in the last 2 years. So we have a problem with the NBFCs no longer being able to grow, focusing on survival. The small private banks, which were growing very rapidly, I think the last 3 months, they also started to slow and focusing more on survival. In the 12 months to January, the incremental credit from external commercial borrowings was almost the same as the incremental credit from domestic banks. And now, given the dollar crisis globally, though the Fed is doing a lot of printing and it's inflating asset markets, I think dollar spillovers is not going to happen very quickly. So ECB access is going to be constrained. And on top of that, now the bond market is also likely to be focusing on survival and managing outflows rather than seeing inflows. So where are we going to get credit from? There are questions arising on how much of the damage will flow through to the banks, because of course, first the enterprises will see the losses, they will erosion of equity, then they'll go to the debt, then the banks will see erosion of their profitability, potentially erosion of book value, and then what happens is that so I think those are all things that need to happen, and I think we need to manage to minimize the damage during this period. I think there is a problem of erosion of risk capital in the economy. There is clearly, there are businesses which are literally eating into their working capital. And many of these businesses are all about the working capital they have. And so by the time the lockdown is over, they could have actually destroyed much of their capital. And then their growth potential starts to weaken. Third is, of course, the enterprises that get damaged potentially because they are forced to shut down. And the fourth is the drop in investment intent. The longer this lasts and the worse the damage, I think people will be much more cautious, let alone consumption, which I think is going to be a problem, but I think investment intentions will be weak as well. So during the lockdown, I think we need to manage that and we need to track that. I mean, how much is the loss really and how do we allocate it to shareholders? And I don't just mean the listed companies, it's a very small part of our economy, but equity holders, debt holders, and our kids, basically the future taxpayers who will bear the cost of any fiscal intervention we do. Post the lockdown lifting, the question will be how much of the potential has been damaged. So if you were growing at 7% in the last 30 years, is the potential growth now going to be 4%? Because we are going to be in a much weaker global growth environment. I'm just throwing a question. This is not my forecast. And in the eroded risk capital in the economy, and depending on how much of damage has been done, what are the challenges in terms of growth, potential growth for the economy. Because whether we have -2% or -4% in FY21 is just an accounting exercise. You know, if you keep the economy shut, obviously GDP will fall. But what I think matters is more forward-looking potential. And that is something that is going to be critical, especially when it comes to debt sustainability. So when the fiscal arithmetic is being done, there are a lot of questions on, you know, what will the rating agencies say? How will the currency markets respond? My fear is that if we don't get growth right, we are going to see challenges on our ratings anyway. So that's the starting remarks. I would let the other speakers step in, and then we can move it more to fun.
Thank you, Neelkanth. That's a very sobering take on where we are and what we need to do. Let me turn to Pranjul and have her give just some initial thoughts on perhaps where we are, and then I want to loop to the others and then come back into a conversation with all of you. I have a number of issues that you've already thrown up, Neelkanth, and I'm sure the others will as well. So Pranjul, please.
Yeah, thank you, and great to be here. So I do agree with a lot of what Neelkanth is saying, that opening up will not be as sudden as shutting down was. and we'll probably only open up partially, and there'll be a lot of back and forth, between authorities and industry. But I think it's good to sort of think through, how the next couple of weeks could look in terms of a recovery, and a couple of thoughts there. I think we could see some, recovery showing up very quickly, at least in the very near term as the economy begins to open up. And I think there'll be three major drivers of this. One would be postponed consumption demand. I wanted to buy water paints. The shop was shut. The shop is open now. I go and buy it. Inventory restocking demand. Retail shops were not stocking up water paints for so many months, and now when they get an opportunity, they want to do so. And third, just the natural buoyancy of India, a market of 1.3 billion people buying and selling to each other, supporting growth. Oil prices, low oil prices will also help here. So I think all of this could help bring some sort of excitement back into the economy once we start opening up partially. And in that sense, perhaps, the next couple of months could look slightly better than how the last 1.5 months have looked. But I think this is where the good news ends. I think beyond this, and once the first wave of demand sort of goes through, the big question will be, where does the second wave of demand come from? And I don't think there are any clear answers there. In fact, my worry is that we've done some medium-term damage to the economy over the last 1.5 months, particularly the financial system and also India's the labor force. Financial system, we already know that already before coronavirus, back in 2019, banks were battling with high mountain of non-performing loans. They were extremely risk averse, not really lending. Shadow banks had huge asset liability mismatches in their balance sheets. And that was where they started. And now over the next couple of months, as they get punched on their faces with even more NPLs, I doubt they'll come out of this very fit and fine. And if they don't lend in the medium term, then who funds growth? The second vulnerability is labor force. So many people have either moved back from urban to rural, or are just waiting for the first opportunity to move back from urban back to their rural villages. Will they come back? When will they come back? Will recovery be a start-stop button? Will it be very easy? I think these are very difficult questions. And here it's not just about domestic movement of labor, it's also international movement of labor. We get a lot of news and information that people want to come back from the Middle East, and that could hurt our remittances and a lot of families in India which depend on remittances. And where do these labor force get employed over the next couple of years? So I think these are two fragilities we'll have to think about carefully. What can authorities do here? I think the basic minimum for sure, which is spending as much as is needed on healthcare, quite a bit on social welfare, for example, direct cash transfers. And then over time, also start thinking about recovery rather than just fighting economic distress. And here, I think authorities will have to think very carefully. Do all the key economic agents have enough working capital to work with? I think there's a problem across the board out here. We already know that the RBI is trying to give money to NBFCs, to big corporates, and also to mutual funds via banks. But banks are very very risk averse, and they're not really doing their job at this point. And therefore, the RBI may need to step in here and take some credit risk itself. State governments, central governments, both will need some helping hand. We'll have to think of innovative ways to work around that. The commercial banks itself will need some help. Some upfront bank recapitalization bonds will be necessary here. So we have to think through each and every economic agent and how do we get working capital to them. So, these are some of my thoughts for now. I also have thoughts about, how the economy in the next sort of 10 years will look once the pandemic is behind us. But I think I'll wait for that for later in the webcast.
Yeah, I think you made a very important point there, Pranjul, about are we depending too much on our banks, and just the availability of liquidity, is that enough, given the risk aversion that is so rampant in the market at the moment? Just on your thought about what the economy is going to look like 10 years from now, some of us have been discussing what's the economy going to look like on the 14th of November. That's Diwali this year. And you could just ask the same question for the 25th of December. What's it going to look like at Christmas? Certainly last year at Diwali or at Christmas, none of us could have ever imagined this is where we are going to be. So I think we are really going to have to think about the next few weeks, the next few months, and as you rightly said, the next 10 years as well. Let me turn to Samiran Chakraborty, Citigroup, and then I want to come to DK Pant because he's, of course, the foundation and the credit rater for all of us. So, Samiran, please.
Yeah, thank you for giving me this opportunity, and good evening, everyone. I want to keep my comments very short because I promised Shekhar that this needs to be a conversation and not a monologue from each one of the panelists. So I'm quite conscious about it. And a lot of things Neelkanth and Pranjul has already talked about. So let me start off by saying that in terms of my forecast, I am probably now the most optimistic on the street with about 1.7% GDP growth forecast for FY21. I don't know how long I will be able to sustain this optimism, but at least as of now, I am more optimistic than others. In my book, if there are...
By the way, Simran, we need that optimism. So it's good that you're holding up your end.
Yeah. So Pranjul was thinking 10 years. I'm thinking 10 days whether I will be able to sustain this optimism. So, but there are, if we are able to avoid two things, and this sounds simple, those two things, but maybe quite difficult. If we are able to avoid two things, then maybe my optimism will prove to be somewhat correct. So one thing is that we don't get a second wave of the virus. As soon as we open the economy, and I'm particularly worried about what was announced yesterday about migrant labor, stranded tourists, students, and others. So when you put the word others, then practically it's for everyone. So if you allow everyone to move from every state to another state, you might as well lift the lockdown. You have lifted the lockdown yesterday. So how this second wave pans out, I don't want to sound like an epidemiologist in predicting whether the second wave will come or not, but that remains a big risk, and all bets are off if that happens. And the second thing that I worry about is grave policy mistake. Little bit policy mistakes are fine. In markets, we expect the moon out of policymakers. The policymakers will never be able to deliver the moon. They have their own constraints to deal with. But if we don't get any grave policy error, we are fine. So what do we mean by what is expected out of policy? It sounds simple again. Ensure that a supply side shock does not become a demand side shock. And ensure that a combination of a supply side shock and a demand side shock does not become a credit event. If you are able to do these two things, then practically you have provided the safety net that the economy requires now. Now, some of the problems that Pranjul was very correctly mentioning is about the economy even before the virus was not in the right place. And we all know that. So I'm not for a second suggesting that my optimism is that all those things will get corrected because of the virus. We will have to live with those problems even in 3-6 months' time. So banking system NBA problem will not get resolved because we will do some magic right now after the virus. We can at best hope that it does not worsen beyond a point. And similarly, with a lot of other structural issues, similar problems are going to remain with us for the foreseeable future. So to me, it is a very simple story that the first quarter of the fiscal is gone. Now, whether it is down -5% or -10%, it's more or less academic in nature. I don't think in the market side, nobody really cares much about it. The question is that from July onwards, are we going to get back to the sequential growth momentum that we were seeing before the virus, or are we going to lag that significantly? And I completely agree with Pranjul that we'll see first a bout of activity. It's like a recoil effect. Someone was trapped in his house for 50 days. The moment he is let out of that house, he's going to run. He's going to run to buy things. He's going to run to produce something. that's just natural energy will get displayed. So that way, that quarter improvement is fine. The question is more about the September onward period. If the two things that I talked about of virus not recurring back and grave policy errors not being made, then maybe we see even that period, the momentum continuing. But if those two things happen, then all bets are off. Let me stop here and hope to have more comments later on.
Thank you, Samiran. I think you put your finger on it. We're all concerned about a rebound of the virus, and certainly, unfortunately, Diwali is going to be the time when, in general, viruses re-energize themselves. So certainly that's going to be, and we want to come back to this issue of will we make grave policy errors or not, and you outlined too. Some of it we are seeing already with the credit issues that are coming up. But let me turn with that to DK Pant. DK.
Thank you, Shekhar. I couldn't hear what your intervention was, but continuing from the past three speakers, my take on this whole issue is, yes, I'm not going to repeat what others have already said. I agree fully with all of them. The challenge, as Samiran clearly points out, like Pranjul, how it is going to behave from second quarter onward. I'm more worried about household sector as per the national accounts classification, which initially Neelkanth talked about. So MSMEs and all those. Now, if you look at household from national account sector, it is by far the biggest one, even bigger than the private corporates. The investment by households are highest. The gross value addition is maximum. Savings is maximum. And what we had seen in past 7-8 years, their savings rate have fallen and their leverage has gone up. As of now, the leverage hasn't gone beyond the savings rate. But if this trend continues, then maybe 2 or 3 years down the line, we may see both the leverage and household savings rate in curves intersecting. Now, these are the ones which are affected most during this crisis. How quickly the labor will come back. If you analyze the labor migration, generally around this time, some amount of labor moves from urban areas to the rural area, mainly because of harvesting. Generally, they come back after harvesting is over, and then again move towards festive season during Diwali or so. There are certain states where there's the good news, the migrant labor, especially the agriculture migrant labor, hasn't moved. Because if you look at Punjab and Haryana, and especially in the Punjab, those migrant laborers are more like a permanent labor. They stay within the fields, they have their houses, and they get every facility in the form of food and shelter. So what I've been told is in the Punjab and Haryana hasn't seen that kind of labor migration which we had seen in the other cities. Even as we are speaking, 4 days down the line, lockdown is lifted, and let's assume everything is normal. There's coronavirus has gone. There's no coronavirus. Everything is on the track. How quickly that labor will come back, that will decide how our economic activities in the economy are going to shape up, how the economy's productive capacity will increase, how quickly the negative output gap and other things can be resolved. But the main worry we see as of now is on the state side. We had done some work where we had seen the 60% WMA increase gives just 19,000 crore to the states. And this is a working capital given to the states, 28 states put together, at a time when we are looking at a situation where the top line of the states are shrinking. Because states' own tax revenue, there is nothing which is happening, or roughly only 20% petrol sales is taking place. Property transactions not taking place. Electricity demand is somewhere around 25 to 30% lower than the last year. And the excise, the only excise, why each state is so keen to open the liquor, because that's the excise which they get. Now, all those four have shut down. Now, it's thankfully like on 20th of April, center has given 45,600 odd crore to the states. Otherwise, we were looking at a situation where the salary payment, we had already seen the states deferring the salary of the staff, and which is basically unheard of in the government setup. The staff salaries are deferred. So interest payment, salary, and pension, even if you look at these three, it was difficult for the states just because of the WMA, because after 3 months it has to be repaid, based on their investment they had in government securities, because they get special drawing facility, which is cheaper than the 1% lower than the repo rate, and whatever borrowing they had done. And when they went for borrowing, the Kerala has got a spread over GSEC of the order of 204 basis points. Now, this is making really states' life difficult. And if you want to intervene in the to the public, you want to give some kind of support, you want to start income transfer or other things, it is the states who are in a position which they can do. It's not the center. So the center's role at this point of time, the way policy has to be, you arrange money. Now, because if states are finding difficult to borrow, states' borrowing costs are going up, the borrowing should be done by the center, transfer it to the states as a loan from the center, difficult time, unusual time, call for unusual measures. Once the sanity comes back, normalcy comes back, you can again go back to the normal situation. So I'll stop here and thank you.
So, Shekhar, if permission, let me quickly respond to something that DK said. And
please.
you have to put yourself on mute, otherwise there's an echo. So, see, the state's problem is, I think, a bit deeper than, I totally agree with what DK was saying. And just to quantify things, there is, states in general spend about 35-40 lakh crores a year, which means that they're spending 70 to 80,000 crores a week. And 50,000 WMA effectively means that you have about 4 days or 5 days of overdraft. Now, given that revenues are down 90%, or receipts are down 90%, it's surprising that a further relaxation has not been done. But I think this is, you must have seen that the center's WMA was raised to 2 lakh crores. So brings us to a much bigger question, and which is that the aggregate borrowing by central and state governments is going to be significantly higher than what we have seen in prior years. And given that for the center, at least, the interest cost is already a quarter of all expenditure. And that's one of the reasons which is now constraining fiscal space, right? In the last 2 years, it has been a third of incremental expenditure, because you can't spend on anything else, but you have to service your interest. In a given year, generally, so the gross borrowing is about 12-13% of outstanding stock. This year, quite possibly, and very likely, it will be over 20% of outstanding stock. So the cost at which you borrow this year is going to be very important, because these coupons are going to stay with you for a very long time. The challenge, therefore, is how do you minimize this? And given that for state governments, the RBI cannot intervene, they can't tap foreign investors, and several other challenges. They don't have much disinvestment, etc. And therefore allowing them to raise their fiscal deficit targets may not help. Instead, the center will have to transfer money, even if it is as debt. Because if they go to the market, exactly what DK said is going to happen. If in a typical April, they borrow 8,000 crores and you go out with 40,000 crores, the buyers are the same. So they are going to ask for a bigger coupon. So you have to stop that from happening. And we need to get some clarity as soon as possible from the center on the cost of So what is the borrowing plan? How are you, what deficit are we targeting, and therefore how it will be funded? And keeping that cost low is going to be very important for the fiscal space in future years. If you end up paying 7% for this debt, then you are constraining the fiscal space for quite a while, and your debt sustainability comes into question.
Let's stay on this topic of the states. And Samiran, do you want to come in here? I have a question about, there's a fiscal issue, but there's also a transmission issue and the lockdown sequencing issue that I want to come to. But Samiran, please.
So just on the fiscal side, I think the challenge for policymakers today is, when do we admit that we have gone bust on fiscal? We are right now in the middle of a crisis. If we admit today that there is a serious problem with fiscal, maybe the current crisis simply worsens. So maybe we are pushing the can down the road on the banking side. Similarly, we push the can down the road a bit on the fiscal side as well. And there is some merit in it also. Like, it's easy for us in markets as analysts to say that BPCL divestment will not happen, or LIC divestment can't happen this year, so this is X is the shortfall because of that. But if I'm sitting in finance ministry to throw in the towel in the month of April that nothing is going to happen and there is going to be a massive fiscal shortfall because of that, is not easy. So that way, it is very likely that the space that the government and the RBI is trying to create today is that in the first 3-4 months, our estimate is that they've created liquidity worth about 2.5-3% of GDP, which will make them survive the first 3-4 months. It's one, through increased WMA limit. Second is through massively increased T-bill issuance. Now, and RBI indirectly supporting the government finance by participating in the T-bill auction and then switching those T-bills into longer duration securities. So this is helping in a way to tide over the short-term liquidity mismatch for the fiscal. The question is that as long as this Damocles sword is hanging over the market about how much the fiscal slippage is going to be, who is going to fund it, you are not going to see the kind of decline in the risk-free rate as you would normally expect. With the operative rate at 375, 10-year government security, I'm not even talking state government, the central government security at 610 is a spread of more than 200 basis points, which is simply not normal. So even without any RBI rate cut, this could have been brought down if RBI was a bit more courageous in going ahead and saying that this is a year where we have to fund the government. You want to call it printing of money, QE, direct financing, deficit financing, OMO, I don't care. These are all names for almost the same thing. But the guidance right now is missing in the market. So the guidance that RBI will become the buyer of the last resort also is, I think, going to be quite crucial.
Pranjul, please.
One point on states, which is that, we're talking about it today, but I think they've been squeezed out from before. Even the 14th Finance Commission had said that 42% of the central government taxes need to be transferred to the states. And what we saw happening is closer to about 30%. When we had the budget in February, that was the number. So I think a lot of thinking has to happen there as well, that even in normal times, states were getting squeezed out. So just imagine what happens to states during abnormal times, and how do we really think about it over the medium term? For now, because there are no sort of simple solutions, there's this one idea I wanted to leave out there, which is that all the OMOs that the RBI does, it generally accepts central government paper. Is it possible that the RBI starts accepting some state government bonds in the OMO window? I know RBI is a little worried about taking too much credit risk, but this has sovereign guarantee. So I think this could be a step that perhaps we can discuss or think about to tide over this year.
I want to turn from the fiscal issue and the state finance issue to a problem that I think we also will face with the easing of the lockdown. Do we expect a sharp divergence in the growth rates of the way in which the states will respond? will some states drag down other states because of the way in which we now have interstate commerce that is happening? So is that because states are going to be impacted very differently? The hot zones are all in the major states where the concentration of economic value and production is. So to that extent, how do we see the way in which, leaving aside the fiscal issues, just the viral issues playing out? Any of you? Neelkanth, you have some views?
Yeah, so the first is that I have this suspicion, and it is totally unfounded, but I have this suspicion that the lockdown will be relaxed without telling us, meaning that, in the last couple of days, so as you know, I've been on driving duty the last 1.5 months, so driving my wife to the hospital every day. So I have a good sense of.
I should say that it's your wife is well, but just she's a doctor.
Yeah.
People may wonder if she's not well.
Correct. So yeah, thanks for clarifying that. So that has allowed me to get a sense of traffic on the road, right? So I've gotten used to doing this distance in like 9 to 10 minutes. I can actually time it to the second because it was a totally empty road. In the last 3 days, and this is now becoming progressively worse. Today evening, I was actually starting to honk at people, and this is in a city like Mumbai, close to the hotspots of, and I live in Lower Parel, so this is Worli is a containment zone, Nagpada, there are lots of on the way, and the number of police checkposts, there were 3, now there are only 1, and even there they're mostly tired and they're not following up. So it gives me, and there are roads being constructed, there are large trucks moving around with a lot of cement. I mean, those big dumper trucks. I have this suspicion that no one wants to take the political call. I was surprised when Odisha said that let's extend the lockdown. So no one wants to take the political call of the responsibility of whatever may happen because of the virus, what Samiran was talking about. And yet you realize that you cannot really extend the lockdown because one, of course, the economic cost, but more importantly, everything in an economy with $2,000 per capita is actually essential, right? So you have to open shops over the weekend because people's pressure cookers are not working, light bulbs are not working, the faucets are leaking. It is very important for people to access those shops. There is very little non-essential that we do in our economy, and therefore, to address the question you raised, my sense is that there will be a period of, I think, 3 to 4 weeks. To give you, someone was quoting these numbers to me. So e-way bill generation, which used to be 22, 23 lakhs a day before the lockdown, had dropped to 1.6 lakhs a day. And then it picked up to 3.5, and now it's 7.5, 8 lakhs a day. So, so the trucks are starting to move. There will be a 3-4 week period where people figure out, yeah, those Havas are open. Some driver will tell his friend, yeah, no, now I found work. Just like traffic is going up in Mumbai, no one is told that lockdown is now much less stringent. People are hearing from neighbors and trying to move around. So I think what it does to the virus, I'm not commenting on. But from the economic perspective, I think the next 3 to 4 weeks, we will see a progressive improvement. What I'm worried about is demand. So I'm actually so Pranjul and Samiran both said that there could be a bounce back. I think that bounce back will be adjusted by this period where we have a lockdown without having it, and that the supply chains can get replenished during that period. Because for cars, for example, there is already 1 month of inventory. So I see less of an issue in terms of the interstate movement. I think those will get freed up very quickly. What we should worry about is the demand issues and potentially the stuff that is coming from abroad. I mean, as I was hearing on a podcast yesterday, that mall shutdowns in Europe and the US have meant unemployment in Bangladesh. So those kind of issues, I think, will be much harder to resolve. But otherwise, in 4 to 6 weeks, I think mostly we are a very adjusting society. Sometimes you will have to help or work with the local administration, and it can get sorted out. There will be DMs and SPs who will be worried about reputation and what is the law, etc. By and large, I think there will be enough flexibility. I mean, we are one is the law and the other is following it.
You know, NCR has been doing these rapid telephone surveys, and we did the first one at the beginning of April, and we released the results on the 12th of April. We've just completed the second one, and we'll actually be releasing the results tomorrow on a webinar similar to this. And incredibly, we still find that the attitude towards extension of the lockdown for another 2 weeks, so this is post 3rd May, we asked the question. I'm announcing these results a little bit in advance, but again, we find solid support for the majority of people saying, yes, if necessary, they will agree to a lockdown. And on the other side, there's also the perception that the costs are very great, especially for casual and day wage workers, because we segregated the households. So this is a puzzle. There's still a fear, and yet there is, as you said, there's going to be a kind of explosion of activity that will happen once the lockdown is lifted. In all this, and thinking about the states, you wanted to comment, Samiran?
Yeah, sorry, one small thing is that what connects with what Neelkanth was saying, we have started publishing a daily data dashboard to track activity. And a very interesting trend is coming out of that. We publish it weekly, not daily. It will become too much noise to publish daily. But what is coming out is that as we are approaching the April 15th, the activity levels started picking up as if people started believing that April 15th, the lockdown will get over. And then April 15th to the April 20th and all, things again fell off a bit. And now again, it is starting to pick up as people start believing that 3rd May, the lockdown is going to get over. So I think it's all in your mind. The ability for authorities to implement the lockdown appears to be not adequate, given the size of the country. It's all in people's mind. If they believe that the lockdown is getting over, they will just come out on the street.
Pranjul, you wanted to come in here.
Yeah, so on, how could some sort of a recovery from here, even if it's a short-lived recovery, how could it look? I had 2 points to make. One is that I think manufacturing will do better than services. So the states which have more manufacturing as a % of their GSDP stand to benefit here. And the reason is you can store manufactured goods. So, it meets your restocking demand need. And the second is just the nature of this crisis. Like high-touch services are probably going to be banned for longer. So I think there will be an advantage that manufactured goods will have over services. That's one cut. The other, which I can't help talking about is rural being a bit better than urban, because so far the COVID proliferation in rural India has not been as much. And even when we got the Home Ministry Affairs press release, 2 weeks back, most of the rural activity is being opened up, rural agriculture, rural construction, rural industry, whereas a lot of checkposts and a lot of closures are still there in urban. So perhaps this could be a window of opportunity for rural India to step up. Remember, for decades we are complaining that rural India only hobbles on one foot, only agriculture. Perhaps now there's a small window of opportunity for it to pick up on things like food processing industry or things like that, because it will have some period of advantage where it can open up more than urban India can.
Let me turn to a point that came up. I think it was DK who brought it up, I'm not sure. But what's going to be the role of the Finance Commission? We've got an interim report. In a sense, they haven't yet given their final award. How should Mr. N.K. Singh and his commission really reconfigure their thinking in light of where we are? DK?
Role of Finance Commission is, I think, first they have to how each state is going to perform economically post this crisis. As Pranjul was saying, manufacturing industry or industrialized states are going to get benefited. Now, say for example, couple of states like Kerala, my home state Uttarakhand. There are many other states who rely on tourism. Now, for these states, if I go back and look at NCAER tourism survey, that gives somewhere around 6 to 7% contribution to the GDP at the national level. Now, forward and backward linkages of that is so strong, so strong. Say, for example, your entire Katra city, right, that is dependent on Vaishno Devi temple. Now, that is whether you say the religious tourism, religious pilgrimage, or whatever. Now, so somehow, I don't know whether they, within their time, whatever time they have to look at each and every state which is affected more by the COVID, because it's good what Pranjul was saying, the manufacturing or the agro processing, food processing industries coming closer to the rural area. Ideally, why should be Apple jam factory should be somewhere in Delhi and Mumbai, whereas the apples are grown mainly in the Himachal and Jammu and Kashmir, so they should have somewhere closer to that. Now, if we can break that, if we can do that somehow, the urban centric to rural, or what we say the semi-rural, semi-urban, or so what to say the Mufassil town, if we can move that, we'll be able to reduce, take care of many things. A, the migration. B, the pressure on the urban infrastructure, urban services, and all those. Now, again, another ray of hope is what the IMD's initial forecast of the normal monsoon this year. Whatever the preliminary estimate on the wheat procurement tells us that the Rabi crop has been relatively better and better than what most of the people were expecting. Now, when most of the people, those who have moved from the urban areas to rural area because of this pandemic, they have place, they have moved out of rural area because there's nothing to do. Or let's not say nothing to do, the opportunities are less in the rural area, so that's why they have moved to the urban area. They will certainly move back to the urban area. How long? Until the time the demand which they were creating in the urban areas, that demand may shift to the rural area. But with the rural areas having limited money power individually, whether one farmer or one wage earner in the rural area with the 4 more people coming in, whether that will be able to kick up to the demand which will revive the entire economy. This is still a question to debate. So I think Finance Commission has to go beyond one size fit all. Okay, you can decide X% of the taxes will be shared with the states. But in the interstate distribution, where they have the formula of population, horizontal distance, and all those, they have to bring in some of this aspect, whereby you can take care of those states which are affected more by this pandemic.
From the Finance Commission, let me turn to the financial sector, where, of course, all of you are situated. Is the financial sector, I don't want to use the word too damaged, but too fragile for us to depend on it for a rapid recovery? Or can we be confident that, as Samiran said, when there's a demand and a supply shock coming together, which results in a credit crunch, are we looking at something like that? Samiran, do you want to take that?
Yeah. So I don't know to what extent the Finance Commission can address this issue, but just a small point before I answer your question on the Finance Commission issue. I think one of the interesting areas that the Finance Commission now...
We have an echo, so I just want to make sure everybody's muted. I need to mute you. Okay, yeah. DK. Yeah, that's good.
Thanks, Elder. So one of the things that is slightly overlooked, and maybe the virus puts some emphasis on this, is financing at the 3rd level. So which is beyond center states into the urban local bodies, municipalities, etc. I think that's one area which, if you have to have these kind of containment zones and the ability of those containment zones to function independently, have the financial resources to do things the way they think it's fit, then I think more allocation needs to go there. On the particular question that you asked me about the financial sector, I guess the issue that we are struggling with today is that the RBI is thinking that if they're providing enough liquidity to the system, then the market mechanism is good enough to allocate those resources in a proper way to whoever deserves it. But I think at some level, the central bank will have to cross this Rubicon in acknowledging that there is a market failure. I suspect that what is going on is that there's a lot of nudges and pushes given to the system and hoping that at some point of time, the system will wake up and do this allocation of credit in a proper fashion. But that might be too late. And this is one part of what I started off saying, a grave policy error, is where you delay this process beyond a point, which has implications. So that's one side. The other side is simply on this moratorium issue. You know, the moratorium looks fine to start with. But question is that if my optimism turns out to be wrong and the economy does not recover in 3 months, then how long will you keep on pushing this moratorium? Because at some point of time, people will have to come and pay. So this is a slippery slope, and clearly that exit plan, which the governor refers to as coming out of the Chakraborty, that we have to have some plan around how to come out of the Chakraborty too. And the third part is this differentiation between banking sector versus NBFCs. I think at some level, the stress is probably much more on the NBFCs than on the banking system. Now, it's an open question to ask, which is that, do you need 30% of the system to be NBFCs or not? We have lived for long with NBFCs at 15%, 20%. So if in this process, NBFCs come back to 15, 20%, that's probably Schumpeterian creative destruction, that's fine. But if you think that NBFCs should stay at 30%, then I think we need to do more on that front to ensure that every part of that chain gets support. Today, if I may use the word, there's a bit of a stepmotherly treatment for the NBFCs, which needs to be corrected. So these are 3 points I want to keep on the table. I'm sure Neelkanth, Pranjul, they will have more points to add. This is a PhD thesis in itself.
Thankfully, I don't have to do a PhD. I've still done, I haven't even done a postgraduate degree. But so the point is,
Neelkanth, can I just turn to Samiran for 1 second, and then I'll bring you back in. Samiran, Sudipto Mandal is asking a question. What underlies your optimism in your growth forecast? I know that Sudipto, who is with us, is struggling with our own growth forecast, trying to keep them positive. They inevitably are giving negative signs to him. So I think he's keen to know what is it that's really keeping your animal spirits up?
So thank you, sir, for giving me an opportunity to clarify the numbers. I did not want to bore everyone with the gory details of this. But let me first start off saying that this is my forecast about the official forecast that will be published. So we all know that there is a 100-150 basis point of upside bias that gets built into the GDP number. So when I'm saying 1.7% GDP growth, it will feel like 0%. And you know the reasons. I mean, 10% of GDP is government expenditure, which will probably grow at 30%. You have 10% as financial services, which probably just will get proxied by credit and deposit growth, which will be okay types. There are sectors like telecom, etc., which are going to do reasonably well. Agriculture, as we discussed, is perfectly fine. So a large part of how we measure GDP in line item by line item might not be impacted as much. if I do a simple, what I call a workday effect model, I will get a much, much more massive thing. So just to give you one example, if I just say that till May 3rd, the full lockdown will continue, which means every day my assumption is 45% of GDP will get lost every day. And then from May 3rd to end of June, this 45% will get gradually reduced to about 10% by end of June. That itself is more than 600 basis points of GDP loss in first quarter itself. You are never going to recover 600 basis points in the 3 quarters. So if you take that approach, you're going to end up with negative growth for sure. So it depends upon what modeling technique you are using to get this number. So we have in our reports put everything in front of the audience to guess. But since I have to forecast a faulty number, so some of the methods will also have to be somewhat faulty.
It's a supreme defense, I must say. I mean, I wanted to clap and say hurrah. I mean, that's a great defense from you.
Yeah, Samiran, I'm impressed at your candor and your willingness to bear all. That's very seldom seen in market circles. I'm
hoping media is not going to quote me on this.
Neelkanth, you wanted to come in and then Pranjul.
Yeah, so on the financial sector, I must tell you the kind of questions that people are asking, right? And I don't think this is likely. This is the likely outcome, but when you're talking about the fragility of the financial system, see, by now we have seen that pushing the PSU banks to lend is like pushing on a string, right? We now know NBFCs are trying to survive. We now know ECB is not going to come. We know small private banks, which were only say 0.5 to 1% of total credit, were still growing at 25-30%, so adding much more to incremental credit. And now the bond market is seeing massive outflows, right? So despite the RBI's intervention, we have seen nearly 22,000 crores go out of credit funds and bond mutual funds, and only 2,000 crores of that facility has been utilized. So, so there's a clear problem. So there are just 4 big private banks and 1 large state bank, which are going to be providing credit. Even the 4 private banks, and this is the important thing, I get asked questions by institutional investors who have a few $1 billion invested in equities in India. How can you convince me that 1.5 years down the line, India's banking system will not be fully nationalized? Right. So you see, the question is that exactly the moratorium issue that came up. I mean, how long can you keep postponing? I think you can postpone it for very long because, you know, the best way to, so if this is a quarterized problem, right? So if this is a problem which is a 4-month problem, then that loss you can freeze and you can let the system to grow and you can grow out of the problem. So these 4 or 5 banks, and you'll still have a long tail which you need to address. But the point is, if you grow at 15% for 3 years, this problem becomes manageable. And if this is only a 4-month problem. So the way I look at it is that there is so when we are looking at the asset side of the financial system, the credit quality issues are going to be of supreme importance in terms of the response of the financial system. Because see, as of now, most large banks can get deposits at 3%. There are public sector undertaking bonds which are available at 7%, 7.5% each. There are companies which I think, you know, are backed by very strong collateral. Bonds are at 8%. I mean, it is very easy banking, but still those yields are where they are. And I think the fear that most private banks would have is to look at it this way. If suppose there is a 6 lakh crore loss, right? So if you say, if Samiran's assessment is 6%, suppose, and I'm just taking that ballpark number. That's not his forecast, I accept. That's like 12 lakh crores. Now, 12 lakh crores of lost income will first take away, as I was explaining earlier, the equity of the enterprises. Then, once that is wiped out, it will go into the bondholders or to the debt, the lenders, and then the lenders' equity will get eroded. So I think it is a very fragile system where we are expecting 5 companies to hold up credit growth in post-lockdown. But even during the lockdown, I think it is creating significant distortion. So the first question you had actually was on rate transmission. The weighted average lending rate is, I mean, I haven't seen the recent update, but it's not coming down. I mean, we are seeing, I mean, 6 months back we flagged, or I think 9 months back, that it is at a record high, the gap between the weighted average lending rate and the repo rate, and that's still not coming down. So I think it's a very fragile system, and I think it needs to be addressed.
Just on that, before I turn to Pranjul, Neelkanth, if Mr. Shaktikanta Das were to turn to all of you, what would you say would be the most important thing that the RBI should do? And clearly, indeed, also engage in, which of course they do, in a dialogue with the policymakers here in Delhi on what combined operations and combined activities and combined, I don't want to call it a fiscal stimulus. It's not a stimulus. It's really a ICU situation, or it's a situation where you're not just stimulating, you're really reconstructing in some sense.
And so, you are addressing the instrumentality of the loans. So you are in a normal time, if you provide adequate liquidity, or taking the expense. So if your water is there at the top, I mean, the plumbing is enough that the water will reach where it is required. In times like these, the plumbing gets choked, so you have to clean up that plumbing. Now, invoking Article 18, directing lending or directly lending to corporate is something that is, I think, a last resort. Many other things can be tried beforehand. And I think credit guarantee fund is something that has been in the works for several weeks. I mean, that's something that newspapers are saying government is working on. Something like that, and a blessing from that. I think some relaxations potentially to the NBFCs, and with the backing of I think opening a bit more of liquidity windows, because these are extraordinary times, and I think opening the liquidity will actually minimize the damage, right? So we, despite the failure almost a week back, I think the fact that there are actually bond mutual funds are still seeing outflows. I think if we quickly, maybe we can still prevent irreparable damage if we intervene now. And this has to be in conjunction with the sovereign, because you will need some kind of contingent grant that if there is a loss because of this intervention in the bond market or providing credit to NBFCs or liquidity to NBFCs, then the center will back it up. So something like that, I think, is very important. I think the credit guarantee fund, where the government itself foresees that, see, eventually I'll have to come in. I mean, it's like, one of the when senior policymakers who's now retired told me, don't look at the cost of saving a firm, look at the cost of not saving a firm. And so knowing fully well that cost is very important. If we do that upfront, so we suppose put in whatever, 100 rupees with 25. So if what the newspapers are talking about, a 3 lakh crore contingency, a credit guarantee fund with say 20%, 25%, I don't know what the number is going to be. So the government is willing to say that 75,000 crores of the loss to the economy, I'm willing to bear upfront. And it's not them. I mean, I'm kind of imposing it as the cost for the future taxpayer. That is something that will prevent the damage from cascading through enterprises and then through the banks, and then eventually you have to recapitalize them anyway, with a lot of loss of future taxes. So both of these actions, I think, are required.
Pranjul, please.
Yeah, I wanted to just comment quickly first on Samiran's point on actual GDP data versus how growth is looking on the ground. And I think it's pretty well known now that this lockdown is interfering a lot with our data collection systems. Even for the CPI data that we got in March, only 66% of the price quotations had been collected. And for the IIP data for March, they're doing a lot of it via phone calls, but the sample size is actually very small. So to the extent, both the CPI and both the IIP are used in GDP estimates, that in itself could, create some problems for the GDP number. So I think he's onto something. On the financial sector, I think, a lot of very good things have been said, so I don't have too much to add, except that I agree, and I started off with this, that we're expecting too much from our banking system. You help out the small businesses by debt moratorium, you pass on all the RBI money to mutual funds, NBFCs, corporates, at a time when you're yourself, struggling with all your legacy problems. So I think that's a problem. In terms of what we can do, what authorities should do, and I think Neelkanth mentioned it, but I'll just add my top 3 picks. One is for small businesses, we must have a partial loan guarantee sort of a system, which at least from media reports, you hear that it's in the works, in the very final stages. I hope it comes out sooner rather than later. The second is at the LAF window. The RBI, I think, should start accepting more, for example, corporate bonds, and from more people, for example, mutual funds from NBFCs. This is actually a very win-win situation. RBI helps out directly where the banks are not being able to intermediate, and yet it doesn't take on too much credit risk, because on the LAF window, it's not doing outright purchases. It's only taking on that instrument for a particular period of time, and it can sort of attach a suitable haircut to it. So it may minimize its credit risk quite a lot through that. And I think my third recommendation is bank recapitalization bonds. I think it should be done upfront. Gives a lot of firepower for the banks to intermediate and pass on a lot of the stimulus which RBI is talking about, but it's not reaching the needy pockets. So I think these are my top 3 picks on what we should do in the next couple of weeks or months.
And so these are all falling into the unplugging of the plumbing that is really not allowing the RBI to actually get the action that it cannot get by pushing at the end of a string. Just before I turn to other topics, and we are an hour and 16 minutes, I have a whole host of questions that you can also see. Samiran, one question to you from Indira Rajaraman. What about targeted LTROs? Hasn't the RBI already crossed the Rubicon with support to NBFCs?
My sense is that still not crossing the Rubicon, because the point that Neelkanth was also mentioning, the issue is who takes the credit risk. As long as you are asking the banks to take the credit risk, which is the case still with TLTRO, you are unlikely to get much success in times like this. So the credit risk will have to be borne by either the RBI or the government, at least temporarily till the markets are dislocated. Once the markets come back to normalcy, then these things will work. Otherwise, we are going to be stuck in this muddle-through situation for longer.
As we think about the next few months, and we focused a lot on what needs to be done now, how does the Indian economy, in your eyes, look at the end of the year, and maybe going forward 2 years from now? Is this a chance to reboot and restructure the economy? Will the politics allow a reconfiguration of many aspects of the economy that we've been trying to deal with for the longest time, whether it's agricultural subsidies, whether it's a social security system that we don't really have, the whole notion of migrant workers and the way in which their plight has now been revealed to many of us who perhaps just weren't conscious of what is going on. Any thoughts on the longer term view? And obviously, when you have such a longer term view or a vision, you want to then work it backwards to what needs to be done now to support that trajectory or view. Pranjul, I know that you've been thinking a lot about this.
Well, I can't claim to have answers to all your questions, but let me give this a shot. I think, there could be big winds of change across the world, once this is behind us. One of the few things that we could see is a huge wave of home bias, self-reliance, producing at home, having national champions, and all of this could shorten the global supply chain. It could lower trade flows. To be fair, it's already been happening ever since the global financial crisis. Global trade has been on the decline, and perhaps after this phenomenon could only pick up pace. But even in this shrinking pie, there could be new opportunities, as many buyers from around the world start looking for new suppliers because they want to diversify their basket. And that's where a country like India could raise its hand. It was not a part of the supply chains 2 decades ago, but it can be a part of the supply chain in the next 10 years. And I think I've heard a lot of optimism around it from many people. I think it's a fair point, but the truth is these gains don't come very automatically or very easily. I think every country who wants to gain has to fight in a very competitive world, and there's a lot India has to do here to benefit from this opportunity in terms of really improving ease of doing business, ramping up on your hard infrastructure like roads and ports, ramping up on your soft infrastructure, for example, lessening your regulatory cholesterol, and also, policy certainty, a stable, predictable tax regime, more openness to trade. There's a lot that India will have to do in order to benefit from this. And a lot of the reforms that we do in the next couple of years will be important. The second is foreign capital. In case, if global trade shrinks, and if, for example, things like capital controls come in vogue, then capital will need far more return in order to take risk, and especially in emerging markets. And this is when those EMs which can give you high GDP growth rate are the ones which will be able to attract foreign capital, and the others could just get left out. And again, a lot will depend on how we are able to ramp up our growth, ramp up our reforms in order to be winners and not losers in the system. And finally, I just don't want to be completely negative. I think there is a good winning sector here, which is digital services. I think this whole working from home is going to convince a lot of global clients that they want to invest in IT. There could be a lot of digital transformation, investment in cybersecurity, in cloud migration, and I think Indian IT companies are pretty adaptive, and can take most of this. So I think here we do have an advantage, but in things like attracting foreign capital or attracting more manufacturing, we'll have to work really hard. And finally, in terms of reforms, I think that will need its own webcast, but there is this one point I want to make, which is, I think the first thing we need is a comprehensive, consistent, and well-articulated economic strategy. I think we lack that to some extent at this point. Let me give you just one example. India needs to be clear about how it wants to engage with the rest of the world. On the one hand, we are trying to attract foreign FDI in some sectors. On the other hand, we are slapping higher import tariffs year after year. This gives a very confused message to the rest of the world. I think India really needs to have a comprehensive sort of plan on many of these things. And then investors, both domestically and internationally, can do an assessment and take a call whether they want to be a part of the India story or not. But I think India first has to signal a clear economic strategy.
We happen to have Raghu Kavale, who's the head of India business, I see, on for Infosys on amongst our participants. He has a number of questions to do with what are going to be the new growth sectors for India. And clearly, as you just mentioned, IT and possibly fintech are going to be important possibilities for us. Those of you in the financial sector, Neelkanth, for example, do you have any thoughts on what the government ought to be doing to position ourselves in a much more competitive way and to be able to drive this globally?
Yeah, so I think the opportunities for reform are already quite clear. There is, for example, almost by default, the APMC dismantling that we had all been waiting for 30 years has happened. How long it lasts, and so if the lockdowns continue the way they are, if for 6 months the APMCs are not fully functional and farmers are allowed to sell outside the mandis and buyers are allowed to buy directly, then we are done with the APMC, right? So that's, I think, already a reform. Today I read about how paddy farmers in Punjab, because there's no labor, are now sowing cotton. They were only, the fact is that Punjab shouldn't be, depleting its groundwater and growing something like paddy. They're only doing it because the government bought it. And that reform could be happening automatically. I think the struggles at the DISCOMs are going to create significant opportunities for twisting the states into, when you're dreaming, you might as well dream big, privatizing the DISCOMs. I think Uday was a step forward, but I think states have started reneging on some of their promises. So it is important that this time when the refinancing is, and I think refinancing will be needed. So when they come for refinancing, then we can sort of squeeze them. And I think there are significant change, reforms that we can do on the energy sector. I mean, over and above the DISCOMs, there is a complete change that is happening on because of the the oil price decline. I think the global energy supply chains will shift. More importantly, I think global capital flows will shift. So now that you are seeing right now things are actually quite chaotic. There's massive uncertainty. But what you're seeing BOJ, ECB, and the Fed do is something that, I mean, they are desperate to avoid deflation. So there was this cartoon going around where there's this startled-looking teenager who stepped out of his room, and there's this guy in an overcoat who's asking, "I'm from the Federal Reserve. We're now buying baseball cards." So I think that they're so desperate to get inflation in that the cost of capital, I think, is going to be very low. That low cost will not be accessible to us for the next 12 months. So while there is uncertainty, but I think the uncertainty, once it gets over, I think the cost of capital. So we have to, as our own capital is damaged, and we have a problem in the credit provision. Something more dramatic with the PSU banks and allowing more foreign capital in is all of these will be done out of necessity, I think, and it will create, I think, good opportunities for growth subsequently.
Well, we're in the closing minutes of this webinar, so I just want to go around and pick your final thoughts on how indeed can we protect the economy we have and rebuild it, because that is really going to be the challenge in front of us. Let's start with DK and then go around.
So as I earlier said, the main focus has to be on a couple of points. How can states raise money, or how can states get money at a rate which does not put their balance sheet in trouble for next 10 years? Because borrowing at 894 for a 15-year paper means the Keral's balance sheet or state balance sheet is in stress for next 15 years. Because these are the states are the those who spend maximum. If you look at as under the Constitution of India, health, education, most of the infra spend are done by the states. So that is point number one. Point number two, as the biggest institution, if you look at national account statistics or national income by institution category, it's the household sector. How can we reduce pain? Because that sector has gone through pain in last 3 or 4 years, and that pain is not subsiding. That pain is increasing day by day. And as I said earlier, if even on 4th of May we open everything, where's the labor? And how can we have because one size fits all will not work. It hasn't worked. So we have to devise a policy as per the sector, and B, the policies, the state-specific policies, which will take entire economy. Because ultimately, GDP is sum total of 28 states' GSDP. So the policy which is fit for Tamil Nadu may not be fit for Rajasthan. So we have to have a different policies for each state and each sector.
Samiran?
Well, let me pose an interesting thought while I was hearing to Pranjul and Neelkanth about what we need to do over the medium term. And I am mostly in agreement. I think all of us are in agreement. These ideas of reforms have been written, rewritten, and rewritten hundreds of times. I don't think the virus changes those things at all. It's a question of when we implement it, what's the right political economy time. But just from a virus response perspective, I think the idea that needs to be brewing now is, can we have a segregated COVID budget? We know that this is a one-time expenditure, mostly. If we are able to sort of give an idea to investors, rating agencies, markets, that you will be able to track this COVID budget separately from the rest of the budget, then maybe even if we are doing a direct deficit financing of that budget, there will be little bit more allowance from leniency from the markets towards that sort of a COVID budget. Because everyone says, oh gosh, in 2008-9, we messed it up. We did such a big fiscal package, we could never withdraw it. And from 2008-9 till 2013, whatever problems, the economy, macro stability issues were there, it's all just because of that. So it's a very clear that Chakraborty problem is solved to a lot if this whole fiscal package is through a separate budget, which will be wound up over the years. So I know that it's quite late, so I don't want to go on with my suggestions. Let me keep it to one only.
It's a very interesting suggestion. Neelkanth?
Yeah, I'm actually absolutely in the same camp, because talking to traders, as you can imagine, a lot of our job is talking to exactly the kind of people who our government fears will thump the currency down if they do something creative. So they start with arguments like, oh, the kind of fiscal monetary coordination that G10 countries can do, EMs cannot. And to be fair, none of the Asian central banks has actually opened any special windows, has taken on any direct credit risk, etc. So people have been, by and large, fairly cautious. They've done a lot more of credit guarantee than we have. Actually, we have done nothing. So we need to step up on that. But otherwise, we need to be careful. And I think when I explained to him that, look, there is a necessity to get nominal GDP growth up and running. So even if we get a fiscal deficit because of that, it will actually make our debt to GDP more sustainable. The risk is that if we do nothing, we'll get a downgrade because our potential growth will be damaged. And see, unless we grow, the end of this year, we may be at 75-80% debt to GDP, right? Unless we grow at 10-11% nominal, we are not going to be able to sustain that debt. So we need to focus on that. And therefore, to get to that debt level, we need to, at the growth level, we need to spend. So this guy, being a smart one, said, oh, we're talking about defensive QE versus offensive QE. We can call it whatever we want. But I think the suggestion that we can comfort the market, that look, this is a necessity. This is something that needs to be done. And it is going to protect our future growth. And this is how we are self-disciplining ourselves, because this is a disaster. And therefore, we have a separate budget for this. And this is how this is going to be wound down. The problem with the last stimulus was the explicit stimulus was small. The big stimulus was the sixth pay commission, right? And which then destroyed the fiscal for states and center for 6-7 years. So if we can give that comfort, I think it will allow the government some more leeway in adjusting to this crisis and will also not cause collateral damage.
I get to fully support you that if we can segregate what we have to do now, then markets will treat us much more kindly and will understand that this is indeed in their own interest in future. Pranjul?
Yeah, just, I think in the short run, move from just fighting the economic distress to trying to restart the economy and ensuring that every key economic participant is able to get access to working capital using both conventional and unconventional tools at this point. And I think we've spoken a lot about it, across small firms, NBFCs, bank recapitalization bonds, a lot a lot can be done. Over the more medium term, I think what this whole experience will teach us is which are our vulnerable points. And two of them, as I mentioned, are our banks, our financial systems, and our labor force, 85% of them informal. Can we do anything in terms of reforms for them? I think for the former, for the banking system, once this is behind us, we need to again strengthen our insolvency and bankruptcy code. It's a good institution, strengthen it. It'll help us. It'll help our banks over the medium term. And I think the second one for labor, I think anything that naturally helps in the formalization of the economy, things like the GST has to be thought through very clearly in a completely blank slate once again. So I hope we can pick up these few very important reforms to address some of our key vulnerabilities which stood out during the last month or so.
Okay, with that, let me bring this webinar to a close. I want to thank all our participants who have joined us. And I want to thank all our eminent panelists who shared their insights and their thoughts. I think we have a big challenge ahead of us, but it's precisely through this kind of sorting, and I hope that through this kind of prioritization that we can actually move forward and indeed seek to both protect and rebuild our economy. With that, let me thank everybody for joining, and I want to wish everybody a good night. Good night.
Good night. Thank you.
Thank you.
Thank you.